This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, Wall Street kicking off the new week with a closely watched jobs report. I'm Tom Busby, and I'll have that story.
I'm Stephen Carroll in London, where we're thinking about what's in store for London's restaurant and cultural scenes in 2024 as the economic backdrop in the UK remains gloomy.
I'm Doug Krisner with a look at what the new year may mean for markets in China, India, and Japan.
I'm Kaylee Lyons from Washington, where we're looking ahead to a very busy political season.
That's all straight ahead on Bloomberg Daybreak Weekend. The business news you need to wrap up your week. Available on Apple, Spotify, the Bloomberg Business app, and everywhere you get your podcasts.
Good day to you. I'm Tom Busby, and we begin today's program with a key economic report to begin 2024. This Friday, we get the jobs report for the month of December. And with the Federal Reserve keeping interest rates unchanged since July, each report takes on more significance for the central bank's next move. For more, we're pleased to welcome Bloomberg News U.S. economist Elisa Winger. Well, we've seen a pretty resilient U.S. labor market, along with continued consumer spending that has kept the economy growing, even flourishing throughout this past year, 2023. Just this past week, though, first-time jobless claims showing layoffs are in check, continuing claims a little higher. What are you expecting to see in the December jobs report this Friday?
We are expecting to see a slowdown, softer gains. What Bloomberg Economics is predicting is 135K jobs being created, which is down from 199 prior. And that's our estimate is below the consensus estimate of 170. Also, we are expecting higher unemployment rate, ticking up to 3.9 from 3.7 prior, and also above the consensus, which is expecting unemployment rate to uptick to just 3.8%.
But why the slowdown?
I think the biggest reason is in the month of November, we saw that 41K jobs came from the resolution of a strike. That's just not going to happen. That's not going to repeat in December. Given that, we're just going to see as a much slower, much softer growth. Also, what we saw in November and what we are expecting in December is that not a lot of sectors are creating jobs. In November, although, sure, we got a number that beat the consensus, it was mostly the government and healthcare sector that created jobs. And that's sort of thing we're also going to see in December. So overall, less jobs being created, and probably we're going to be surprised to the downside.
Now, you spoke about the healthcare sector, government sector. These, will you see these continued growth in the new year? And are there other sectors where you really see a pullback expected?
So these are acyclical sectors. They're not being affected by a downturn or any sort of slowdown in economic activity. So these sectors could still grow, might as well grow in the next year. But as we've seen in the November jobs report, a lot of the sectors were either flat or decline. Like, for example, retail sales is very cyclical, and jobs in retail sectors decline, or whole trade. So we're probably going to see a lot less job creation in those consumer-facing industries.
And you talked about manufacturing, the UAW strike that ended, 41,000 added November's numbers, which skewed it a lot higher than it should have been. Where do you see manufacturing heading?
So I think, ISM manufacturing is going to come out on Wednesday, and sector is going to be in contraction for 14 straight months. We probably not gonna see a lot of jobs coming. I mean, there's pockets of strength within manufacturing coming from the CHIPS Act and AI, but a lot of it is just, as consumer demand is going to slow, and we don't expect the holiday season. Like National Federation of Retailers came out and they said that overall holiday sales are in between 3% and 4%. Our estimate is at the low end of that estimate. So I think as we head into the new year, we're gonna see less consumer demand, and those industries within manufacturing that produce goods, they're just not gonna hire.
Now, how about housing, though? We have seen continued demand. We know that existing houses a little uneven, sometimes better than others, but the demand for new houses, which is 3 jobs for every house going up, how does that look in the future?
I do think there's demand for housing and not enough supply. Having said that, the affordability is very low. So even if we would see more houses being available, there is only so much demand. And the demand is being flooded into the new construction market only because there's just not enough existing home for sales. But if the Fed will start cutting rates, that will relieve some of the pressure on both the existing inventory of homes, which will probably rebalance the demand back towards existing home and away from new construction.
If the Fed starts cutting rates, and that's what this is all about, whether job growth slows, inflation has slowed down quite a bit. It's not exactly at the Fed's target. We've seen wage growth slow a little bit, all leading to the first meeting at the end of January for the Fed. And if everything is aligned in the jobs report, what do you expect the Fed to do? Where do you see them in the next few months?
We put out an outlook in December ahead of the meeting in December, which was December 12, 13, where everybody, I think most of us, were surprised at the dovish tilt that Powell basically said, they've discussed rate cuts. We anticipated ahead of that meeting that the Fed is going to cut rates in March by 25 basis points and another 100 throughout 2024. And mostly because that aligns with our forecast. We are expecting less jobs this Friday, and we are expecting unemployment rate to go up, and we are seeing less holiday sales. We are on the lower end of the forecast. The data is still not fully out for the month of December, but it looks like the holiday sales weren't as strong as people were expecting. So all of that tells us we should get the Fed to cut rates in March.
We have the likelihood of job creation slowing down. We have the unemployment rate notching just a little bit higher right now, 3.7 to 3.9 you anticipate. It's not cataclysmic. It's not the sign of a recession. Is it just a little bit of a slowdown?
What we have actually, so we not only have 3.9 unemployment rate in December, but if unemployment rate goes up to 4, that will trigger the SUM rule for identifying a recession. Again, is it going to be a hard landing? No, it's going to be a mild recession. We still think that's probably in the cards. And with the Fed, though, cutting rates in March, possibly in March, that's a smart move on the Fed's. That's cutting rates against an economy that is showing signs of slowdown. And also why Powell pivoted as much at the December meeting is because inflation surprised to the downside. The 6-month annualized core PCE was at 1.9%. So all of that tells you that if we're gonna get an unemployment rate surprising to the upside, meaning it will go up. In our forecast shows that unemployment rate can go up even in Q1 to 4.3 and can peak at 5%. That's not a soft landing. That's a mild recession.
You predict that we're going to see as much as 4.5% in the next 3 months.
4.3 in Q1, 4.5 in Q2.
In Q2, okay. So we've got our work cut out for the Fed, certainly. And they've got, in that time, they have 3 meetings, right? The third one ends May 1st. So we could see multiple rate cuts to staunch the reaction from the economy and from the markets, right?
Exactly. And even as we mentioned in the beginning of the segment, that jobless claims. We're seeing, sure, low layoffs, but continued claims. If you look at the same week, 4-week moving average, continued claims are up 17% between this year and last year. That tells you that it's the duration of unemployment, meaning is getting longer and longer, and that's usually the sign where the market is changing, where there's a shift going on in the labor market. At first, it's taking longer for people to find jobs, and then companies manage headcount going going to manage headcount from attrition to actually layoffs. So that's been happening, and we see that over and over in jobless claims figures.
Wow. So this Friday, a lot to look forward to. Our thanks to Bloomberg News U.S. economist Elisa Winger. And coming up on Bloomberg Daybreak Weekend, we take you to London for a closer look at the UK economy in the new year. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. The UK sliding into 2024 with negative growth, with the impact of interest rate hikes still feeding into the economy. Consumers feeling the pinch from the higher cost of living, but they're still spending enough to fuel London's restaurant and cultural scenes. The weaker pound versus the dollar also has helped attract more big spending tourists, particularly from the US. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, despite the gloomy economic background in the UK this year, it's been a busy year for London's restaurant scene, with several high-profile openings that came after a difficult winter. Add to that, not one, but £2 billion hotel openings. So what's in store for 2024? To discuss, I'm joined by our food editor, Kate Crader, and our Bloomberg Pursuits UK correspondent, Sarah Rappaport. Great to have you both with us. You are our eyes and ears in London. So, Kate, I wanted to start with a serious question for you. Was 2023 a good year for restaurants and for the hospitality sector here in London?
I think that the year in hospitality and for restaurants, it was a sort of glass half full. So you can look at it and say, after COVID and certainly after the train strikes that hit restaurants last year, right at this time, right when everyone was getting optimistic, this has been a much, much better year. And you're seeing so many signs of recovery. Restaurants that had only been open for 4 days are now open for 5, 6, and 7 days. And that's a really healthy sign. And places are packed. On the other hand, places are still struggling. They don't have enough staff. And a report recently came out from an accounting firm, Hacker Young, that said restaurants in London are carrying $3 billion in debt.
Wow.
So as a result of trying to expand too quickly and dealing with problems like food inflation. So there might be underneath the ice that everyone's sort of happily skating on, it might be a little bit thin. So it sort of remains to be seen. So there's things to be really happy about. As you said, there were some fantastic openings. The Wolseley City opened right near our little Bloomberg
convenient
offices.
Around the corner. Yeah,
it conveniently open for breakfast, lunch, and dinner. And there's a bunch of things coming in 2024 that are going to be fun. So there's definitely optimism. Holiday parties are really booked up this year, but I wouldn't say everything's fine and dandy. I wouldn't tie it up with a little ribbon.
Okay, so things also looking kind of curious as we look towards 2024
Precisely.
As well. Sarah, meanwhile, it's been a booming year for luxury hotels in London in particular. You've written some great pieces about this. What is driving the demand for luxury hotels in London?
Well, I mean, it's been a huge year. In September, the Raffles London at the Old War Office and the Peninsula both opened, both which cost over $1 billion each to build. And room rates start at over £1,000 a night for both. So
great. One of
certainly,
each. Yeah,
very expensive. And in terms of who's actually staying in them, the answer is generally rich Americans and people from the Middle East.
Okay.
They're very special hotels. They took a really long time to build.
The Old War Office in particular is a fascinating one because it's a historical building.
It is. It opened in 1906. It's a grand building. It was the head of, the Grand Office of War, right, during both World Wars. Now there's a suite in Churchill's old office with a replica of his desk where he used to work.
Wow.
It'll cost you about £20,000 a night if you want to stay there.
Okay, but you're getting a piece of history.
Yeah, a piece of history, which is pretty incredible. Kate and I actually went to a subterranean bar in the basement called the Spy Bar.
I've actually heard about this.
They used to actually use it as interrogation rooms, right? So now, which is truly, the spies used to go down there. MI5 used to have offices there. Okay. And now it's a bar with, nice £20 martinis.
Yeah, indeed. I mean, look, the strength of the dollar, I suppose, has been part of that story as well, is that it's been helped to support those American tourists that are
huge for both tourism and for the luxury real estate market. Yeah.
Is the fact that they opened this year because of delays, because of the pandemic, were they planned for this year?
It's because of delays. They were not planned for this year, either of them. They're pushed back. It's a story in a lot of hotels. Their opening date's a little optimistic, but they all open within 2 weeks of each other.
Wow. Okay. So
Yeah.
competition in that space as well. Kate, when we think about trends that we've seen over the past year in the food scene, was there anything that stood out for you that was kind of something that you were like, yes, this is, we're now coasting a fad?
Well, Stephen, here's where I remember that I think we were supposed to go have drinks at a wine bar because last year at this time I said wine bars are going to be big in London.
Which I was very excited about.
I'm still excited for this to happen. And the good news for us is that wine bars were indeed a huge trend in London in 2023. There's so many of them. There's a place, especially in North London around Newington Green, a place that opened sort of towards the end of last year called Cadet, has been going super strong. It's so popular. It's been called out. All these places have recognized the chef. They have this charcuterie superstar there. So that's, I think, set the scene for a lot of other places to open. A place called 107 opened, I think it's around Hackney in Covent Garden. 10 Cases has been a popular wine bar, and they just opened a place called Bawdry Green that's a wine bar. And the problem is that now it's become such a popular model that I think places that are actually restaurants are calling themselves wine bars.
Okay,
like
yeah.
in the way that everyone wants to say natural wine. Like you don't just pour wine, you pour natural wine. And so it's very quickly become an overused concept.
Interesting.
I think.
Have we reached peak wine bar?
We've reached peak wine bar. You're right.
That's terrible news for those of us.
How
that
about
love
peak
them.
natural wine? Are we there yet, or is that some time
Well,
to go?
I think that's a good question. I think I'm here for natural wine, but everyone, I mean, it's sort of like saying something that doesn't need to be said. You know, it's just like say that you're pouring wine. You don't need to say natural anymore.
Exactly. I mean, there's a whole other conversation to be had about the evolution of natural wine, which we will have to do on another occasion. But I want you to look into your crystal ball for us and tell us what you're seeing, considering you predicted so accurately the trend for this year. What are you thinking about when it comes to the food scene in 2024?
I will say, I think I love London. I have fallen in love with London. I think Manchester is going to get bigger and bigger next year. I think we're going to be seeing a lot more energy outside of London. It's already happening. Edinburgh is a super hot food city right now, and it's just going to be bigger in 2024. I think you're going to see a lot more local ingredients, partly because of climate, partly because of all the issues people are having and price concerns. So already you've seen some really good sushi places like Dining's SW3 sourcing local food and not necessarily flying it in from Japan. And I think you're going to see even more chefs highlighting the fact that they've got vegetables from Cornwall and seafood from that coast as well. You're going to see more and more of that. And I think also this is very bold, so you can fact check me on it. I think we're going to start seeing the end of small plates. We've eaten so many small plates. So much food has been eaten off small plates. I think we're going a little bit back.
I have a lot of opinions about this.
Oh my God, Stephen. Well, we will keep talking. I know Sarah's
Bring
going to have
back
some
big
too.
plates.
I know, because inevitably you just end up spending 3 times as much money because
So
you think,
true.
I'm going to need loads more.
That's exactly right. Exactly.
Yeah.
And I think there's more, like the Wolseley City just opened, and they don't have like a small plate section. It's a place where you get, regular size plates of foods,
portions.
and you have like food, and you have like 3 courses, so I think that sort of idea that not everything is a snackathon is going to be prevalent
The
in 2024.
3-course meal is coming back. You
think-
heard it here first.
Yes, you did.
Sarah, talk to us about the cultural scene in London this year. What stood out for you? What was your big highlight?
Well, I was just talking about this with my editors at Business Week, and we were saying between me and my boss in New York, Chris, the editor of Pursuits, we've seen over 100 plays and musicals this year.
Wow.
So we've seen quite a lot, and there's some really amazing shows on in London. And my favorite, actually, is Operation Mincemeat, which have you seen it, Stephen?
No, I haven't. Sorry, I could have gasped there about it. No, I haven't, but it's very high on my list. Go on, tell me about
It's
it.
going on till June, so you have plenty of time to book, for both you and your listeners. But it's actually about an MI5 intelligence operation during World War II. They stole a corpse, MI5, dressed it up as an army officer,
Spoiler
washed
alert.
it up ashore on Spain with fake invasion plans of Sicily, right? It sounds like it's a stranger than fiction story.
Yeah.
But it makes for a really hilarious musical with some really touching sad scenes as well. So who would have thought this crazy World War II operation would be the best musical on stage, but it really is.
Thank you to you both, Kate Crader, our food editor, and Sarah Rappaport, our Bloomberg Pursuits UK correspondent. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Our thanks to Bloomberg Daybreak Europe anchor Stephen Carroll. And coming up on Bloomberg Daybreak Weekend, a look at what's ahead for the Asian markets in 2024. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. As year 2023 comes to a close, we take a look at what's ahead for markets in China, India, and Japan in 2024. Let's get to Bloomberg Daybreak Asia co-host Doug Krisner.
Tom, the challenges ranged from a flopped reopening trade to faltering economic growth, as well as an unprecedented outflow of foreign capital. So as we wrap up 2023, we turn to the outlook for the year ahead. Bloomberg's Philippe Pacheco is with us. He is the capital markets reporter for APAC Equity. He joins us from our studios in Hong Kong. I think we can agree, Philippe, that for China, the major problem, not only for the economy, but for markets as well, has been this weak sentiment. Maybe there was some initial excitement around a strong recovery post-pandemic. That never materialized. Is there any optimism that we can expect in the new year that will mean that 2024 is better than 23?
Well, that's correct. I think that it's very hard to find that optimism out there, especially at this time of the year. We usually do a round of talks with bankers, get their outlook for what they're expecting, at least for the first quarter of the following year. When we had these conversations last year, most of them were very, very positive about the outlook for China, especially because at that point we knew that the country was opening up. There was the whole excitement towards the fact that China's economy would be way more open than it was during the COVID years. And what we saw in equity capital markets was this gigantic frustration. For example, China was responsible, mainland China mostly, for about half of all of the deals within ECM that happened in 2022. This year, we have China representing less than 30% for global offerings. So it's very hard to say when this is going to actually improve. There's no perspective that there is a better first half of 2024 than what we saw in the two final quarters of 23. And I think that what investors, bankers, and companies are looking for right now is indication from the Chinese government that there will be support, that there will be measures to actually bring back optimism towards the economy, and therefore they will be looking for money again.
Yeah, I think the slump in the property market has been the central problem in restoring confidence. Is there any signal that the government is sending that it understands the severity of the problem?
I think that there are signals that they are willing to address such problems. There has been indications of support in different ways, especially to the real estate sector. Is it enough? I don't think so. When we talk to bankers, they say that they need more, like the market needs more. They need like a bazooka, something that would send a clear message of support that would give indications that there is a turnaround, that we've hit the bottom and from now on things should get better. I don't think anyone has seen that yet. I don't think there is indication that this is on the way. For example, when we talk to bankers looking at IPOs, they say that we need to see bigger deals. We need to see those blockbusters deals with names that catch the headlines, and we need to see a few of them performing quite well for a while. We cannot see deals flopping. We cannot see IPOs coming to market and then just grabbing negative attention. This is the worst that you can have for a market that is very sensitive to sentiment.
And that's one of the things that I think has contributed to foreign investors removing a lot of capital out of the markets. Not a lot of evidence that the government really understands what the problem is, to the extent that they're really willing to throw, as you mentioned, the bazooka behind it. To what extent is that lack of foreign capital creating difficulty for capital markets more broadly?
I think that it creates a lot of gaps, let's say, within equity capital markets. For example, you have outflows for all kinds of Chinese investments, including equities in the secondary market. Hong Kong's market is going through a very, very hard time. The index here in Hong Kong, the HCI, is down more than 15% for the year. We also have the benchmarks in the mainland down by a similar percentage. So it's just a very, very hard scenario, and you see money just getting out of Chinese assets as a whole. Of course, that impacts the way companies that are considering to tap the markets to make their plans as well. Companies are pretty much on that state right now. They are on pause. They're on hold because they do not know if this improvement will come. And then at the end of the day, of course, if you have money flowing out of China, this money is going somewhere else. We see a lot of optimism, for example, when it comes to assets trading in India and also activity in ECM for India, because this is a huge emerging market that's just like bringing a lot of positive headlines. And then another market that's catching a lot of attention for this particular segment is also Japan. Japan is a developed economy. It's a completely different economy than what you would see in China. But of course, it's been a great year for Japanese assets, especially equities.
Yeah, it's been a very good year for the market in India. I think the major market measures are up double digits in U.S. dollar terms. But if you look at the year ahead, are analysts assuming that this positivity is going to continue, or might we see a bit of a pause? Is it a market that is maybe a little overextended?
That's a very interesting point because we do know that India is trading at very expensive levels right now when it comes to equities trading. But one of the bankers that I talked to was someone that is close to the Indian market. He said, we do know that India is expensive and we hear that from our clients. But at the same time, we ask, are you willing to buy? Are you willing to invest at this price? And they say yes. You can see things performing well. You can see assets just from the fixed income side and also from the equity side doing quite well. That's what investors are looking for in a tough year like this. For example, if you look just of all of the names that sold big stakes in Indian companies, listed Indian companies this year, we're talking about SoftBank, the Canada Pension Plan Investment Board. We have Tencent that had several stakes in companies that listed in India. So these are big global investors that they are coming to market to sell big chunks, let's say 5 to 10% of the stakes that they own in such companies because price is good and they are making money out of it. When those companies put those blocks and those placements out in the market and you see them trading up 2 days after, this is very rare. You clearly see demand coming from the domestic market in India and also from foreigners. So there is appetite. There is a lot of interest. This is India's moment. Is it going to last whenever China is back, whenever activity in China picks up? That's the main question for Indian assets and for Indian issuers.
I think one of the surprises this year in the Asia Pacific has been the performance of the Japanese equity market. I don't know how much of that has to do with anticipation of some type of change in policy from the Bank of Japan, but I think the Nikkei in dollar terms is up more than 17% year to date. The outlook for Japan, is it contingent, the positivity contingent upon the BOJ maybe adjusting policy, or is there something else going on with Japan Inc. that's driving the gains?
I think Japan is a very, very, very curious case. As you mentioned, there's a lot of it that is related to the BOJ. The moment in Japan's economy, this is a turning point for a country that hasn't seen inflation for like decades. And there is a lot of attention that's going towards it. I think when it comes specifically to the equities market and all of these companies that are actually trying to raise funds through equities, it's very interesting to see that this comes in combination with a lot of measures that are being done by the local stock exchange to actually boost governance and to make maybe combine this particular moment in the macro aspect of the country to what's happening within the corporate sectors. So you have, for example, the stock exchange in Tokyo asking companies to just improve all of the governance levels that they have. They are trying to attract more names to the market, and they are also trying to improve the holdings, what they call in Japan as cross holdings. Basically, a lot of Japanese big conglomerates, they own shares of their sister companies, and this is not seen in a good way when it comes to governance aspects. So the local regulator and also the exchange is just trying to unwind such trades, and there's a lot of companies that are coming to market to actually execute it.
Philippe, great that you could be with us and share your expertise on what's happening in these various equity markets across the APAC. That is Philippe Pacheco, who covers APAC equity capital markets from our bureau in Hong Kong. I'm Doug Krisner. You can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia beginning at 7 a.m. in Hong Kong, 6 p.m. on Wall Street. Tom?
Our thanks to Bloomberg Daybreak Asia co-host Doug Krisner. And coming up here on Bloomberg Daybreak Weekend, a look at some of the big political items on the agenda in Washington in the new year. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Lawmakers will start the new year running with a full slate of legislative priorities as soon as they get back from their holiday break. That includes another possible government shutdown. For more, we turn to Bloomberg's Sound On co-host Kaylee Lines.
Yeah, thanks, Tom. 2024 is looking to be a very busy year in and around Washington, between the primary contest for the Republican Party really kicking off in earnest and the threat of a government shutdown, and that's just in January. There's a lot more that's going to come throughout the year. So we wanted to get more on what we can expect in the year ahead for politics. I caught up with Henrietta Treyz of Veda Partners, and we started with her thoughts on the likelihood of a shutdown.
I think that we have staved off a shutdown because shutting down is actually worse than taking the votes to keep things functioning at their current levels. So I think January 19th and February 2nd are just going to roll into March and April, June and July, probably 2 to 6 times through the first half of 2024. The most important date for investors, since we've sort of bifurcated the appropriations bills and we'll only have partial shutdowns of pieces of the government in the event that there are shutdowns, I think the most important date for investors is sort of the run up to May 1st, particularly in the defense space, because I don't think they're going to avoid the sequester early, and I don't think they're going to come up with some grand bipartisan deal, as y'all were sort of alluding to earlier. There is no bipartisanship on Capitol Hill around anything other than, hey, let's just not shut down. So I think as we get into mid-April, investors in the defense space who are looking down the barrel of a 1% spending cut for defense are probably going to get a little anxious, a lot of headline risk as they seek to avoid that at the 11th hour. So maybe keep May 1st on your radar and maybe April 15th around then for headline risk to start moving.
Before we can even get to 2025, to your point, Henrietta, people need to last 2024, which brings me to the Mike Johnson question, of course, the relatively newly minted Speaker of the House who has passed a continuing resolution with Democratic support, which is what got Kevin McCarthy kicked out of the job in the first place earlier this fall. So I just wonder how much longer he's really got if he's going to need to fund the government and potentially does need to kick the can, and House conservatives don't like it.
Right. And you've already seen the House conservatives say, the deal that was negotiated last May with Kevin McCarthy, A, he's not even a speaker, B, he's not even a congressman anymore. And then the next question is, how long is Johnson going to be the speaker? In D.C., if you go to meetings with staff, they'll say, is it going to be 6 months or 6 years? The verdict, the jury is very much out on that one. And it's a popular parlor game, which does not bode well. I think the honeymoon phase is over. I'm going to be really interested to see how members start reacting when they get back into town. It's impossible for about 8 to 20 members of the far right to agree to any spending level. And we're not talking about huge chunks of change right now. The difference between the far right and the moderates in the Senate, which have overwhelmingly passed all 12 appropriations bills, is like $25 billion. And we're talking about a 1.5-ish trillion dollar package. So for the difference to be $25 billion, it's like, me asking you for $5. It should be no big deal. But they literally just don't have the votes for anything that sounds like yes. So those guys are always going to be voting no, which forces Speaker Johnson to constantly be negotiating with Democrats, which is, of course, anathema to the far right. But they are ironically the ones that are enforcing that reality on Speaker Johnson. So I hope he can make it through April. Obviously, we've seen how long a series of votes can go on the potential for another speaker. So I think that'll be really drawn out. Nobody wants to do that, but memories fade, and maybe they've forgotten how uncomfortable that was in October.
That's Henrietta Treyz, managing partner of Veda Partners. And Tom, it looks like we're in for a wild ride in the coming year.
Thank you, Kaylee. That was Bloomberg Sound On co-host Kaylee Lines, and you can hear Sound On weekdays 1 to 3 p.m. on Bloomberg Radio. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.